Hi, and welcome to the Urban Catalyst Opportunity Zone Fund webinar. Today we're going to talk about how to shelter your capital gains using Opportunity Zone investing. First off, we're going to get to our agenda.
So the first thing that we're going to do is introduce ourselves and talk about why it is that this specific subject probably matters to you. Third, we're going to get into the actual benefits of the Opportunity Zone tax program. Next, we're going to talk about Urban Catalyst a little bit. Why should you invest in Urban Catalyst specifically, and what are the projects that you're investing in?
So here at Urban Catalyst, we are structured as a real estate equity fund that is focused on doing ground up real estate development projects in downtown San Jose. We're also an Opportunity Zone fund. And what that means is we're able to give the Opportunity Zone tax benefits to our investors.
Hey, so my name is Morgan Mackless, and I am the Executive Vice President of Investor Relations. My background is actually in tech, but what I've done here at Urban Catalyst is I run investor relations, meaning the investors, as they're making their decision on a potential investment into the Urban Catalyst Fund. Then my team works with the investors as they're doing their paperwork to make the investment. And then third, we work with investors after the initial investment is made to make sure that they're in the loop and having a good experience with Urban Catalyst.
My name is Eric Hayden. I'm the founder and CEO of Urban Catalyst. In general, throughout my career, I've done institutional quality and scale real estate development projects in the San Francisco Bay Area. I've done around $3.5 billion worth of projects, and it's exciting here at Urban Catalyst what we're doing in downtown San Jose. So to talk about Opportunity Zone funds, the first thing we have to talk about is who is eligible for the program. And the answer is if you've had a capital gains event, you are eligible. Here are the three most common ways that folks have capital gains events. If you're here today, it's because more than likely you had the sale of stock, because that's what the focus of today's webinar is. And our plan today is to go through, at least initially, and talk about some of the investor profiles that we've seen as investors into our first fund. Our first fund, we had over 350 investors. A majority of them, their capital gains event was the sale of stock. The first investor profile, Morgan, that we looked at, did you recently make a lot of money in the stock market?
Right. So, we have a lot of investors here at Urban Catalyst that are very clever people, and they have been able to take advantage of the recent stock market going up and down and over. A few examples. Hey, maybe you had Tesla stock. Tesla obviously went way up. We have some crypto investors. Obviously, there's taxes due for Bitcoin. What if you were one of the Robinhood folks that made a bunch of money on GameStop? So we have actually heard all of these different scenarios from our investors. And in this particular case, those investors are going to have a pretty hefty bill to pay to the federal government.
And we also have found, and this has been true across the majority of our investors, is that they're looking to diversify their portfolios. This is especially true if you've held stock for many years and really seen a lot of gains, or if you own stock in the company that you work for. Like, for example, if you work at Google or Tesla or Apple. In fact, Morgan, we have had investors in our first fund from all of these different companies. And what's really important is there's never been a way for investors to sell these stocks and not take such a big tax hit. There's never been a safe harbor for the sale of stock to really shelter those gains.
That's right. And Eric, that's such an important point because having been in tech industry and in tech startups where stock was the most important thing, I can definitely relate to the investors that we've had from a lot of these companies in that you're really just trying to maximize the amount of stock that you have. But what happens once your company is successful is that now that might make up a really large percentage of your overall net worth. And we've all read and been exposed to financial advisors and experts that tell us that you have to diversify out a little bit. And exactly as Eric says, the Opportunity Zone program allows you to diversify into real estate, but to do it in a tax-advantaged manner.
Morgan, interesting story. Our headquarters here in downtown San Jose, we're right next to Zoom's headquarters. And when Zoom went public, we had maybe half of their executives in our boardroom talking to us about their capital gains event. And I've never seen a more excited group of folks talking about their company and all of the profits that they just made personally and what they were going to do with those profits.
I bet they're even more excited today now that the stock is so much higher. So hope to hear from more Zoom people on the next one.
The next type of investor profile that we've looked at is investors that are just sick of the stock market volatility. I mean, the stock market, some people call it the grand casino. Some people call it the roller coaster. And I can relate to every morning you wake up, you check your phone, it shows you the stock tickers of the different stocks that you own. And sometimes, you get that the bottom is dropping out feeling. Stock investing can give you that volatility. When you invest into real estate, it's a much longer term type of investment, especially with opportunity zone funds, because we have the 10-year duration to get to tax-free profits. So if you're sick of the stock market volatility, you want to be into a different type of investment that really gives you the long-term option. Definitely check out opportunity zone funds, because that's what you're going to get.
Yeah, Eric, I'll tell you, during COVID, I guess it's one thing to be on your phone constantly checking the stocks and how they're moving up and down. But obviously, as COVID ends and we all get to our full-time day jobs, that's not the kind of thing that I want to be worrying about each and every day. I really want to be sure that part of my overall portfolio is in a good, solid, long-term investment where I'm not concerned each and every day about big market volatility.
So Morgan, as we mentioned earlier, a large number of our investors, their capital gains event was the sale of stock.
Yeah, in fact, these are some actuals from Fund 1. In Fund 1, we had $131 million in investments from over 350 individual investors. And as you can see, nearly 70% of those investors sold stock in the tech sector and then harvested those gains, put them into the Urban Catalyst Fund.
And obviously, Morgan, this makes a lot of sense. They're able to sell their stocks and then shelter those gains, defer, reduce, and then get tax-free profits. Some examples of investors in our first fund: investors that sold tech stock, day traders, and cryptocurrency has become more popular, especially recently.
Yeah, I'll tell you, Eric, that first grouping, the tech stock, mostly tech employees, was by far the largest contributor in Fund 1 in 2019 and 2020. But now that we're here in 2021, I can tell you that day trading and cryptocurrency are actually making up a huge portion of our investor base, especially with day trading, because day trading is often a short-term capital gain event, and that carries with it some extremely high taxes.
Speaking of those high taxes, this is the federal short and long-term capital gains rates. You can see a long-term capital gains rate at 20%. The short-term capital gains rate, that's really at the same rate as ordinary income, which is around 37%. In general, the difference between these two is if you hold an investment for more than a year, it's technically a long-term capital gain. If it's shorter than a year, it's short-term. However, definitely consult your tax professional to find out how your gains would be treated.
Now, for me personally, if I were to have to pay a long-term capital gain of 20% for stock, say a stock sale, that would be painful because I prefer not to pay federal tax. But I'll tell you, if I were paying short-term capital gains at my ordinary income rate of 37%, I would be highly motivated to find a way to defer and reduce those taxes. And we're hearing the exact same thing from our investors. If you have a short-term capital gain, you're definitely looking for ways to reduce that liability.
And the good news for our investors is that opportunity zone funds, we accept both long and short-term capital gains. So no matter which one you have, an opportunity zone fund can help you reduce your tax burdens. So to get right to the point of what are the three major benefits associated with the opportunity zone program, the first is you're able to defer paying taxes until 2027. So if you had a capital gains event this year, you won't have to pay those taxes for quite a few years. When you pay your taxes in 2027, you get a 10% reduction. What that means is for every $100 that you would have owed in taxes, you only have to pay $90. Now, but the third benefit, Morgan, the third benefit is the biggest benefit. And that is after their money seasons in our fund for 10 years, all of the profits from the fund itself are tax-free.
So Eric, let's go back over this. So first, we have a deferral, meaning that you don't actually owe the government your taxes until 2027. Then second, when you do pay those taxes, they're actually reduced by 10%. And then third, at the end of the 10-year IRS holding period, all of the profit that you've made for that investment that entire time is now federal tax-free. And I'll tell you that most of the investors that I talk to are concentrating on the deferral and the reduction. But Eric, I know you feel very strongly that it's really the third benefit that's the most important. And why is that?
And it's because of the structure of our fund, Morgan. We structured our fund so that we're going to go out, we're going to build these buildings, we're going to lease them up, they're going to stabilize, and then we're going to hold them until we hit that 10-year mark. And right at the end of 10 years, we're going to sell all of those buildings, liquidate the fund, and that's when we return the majority of the profits to our investors, and those profits are tax-free. So that's why it's the most important.
So the money that you made on this investment after 10 years, the profits are now federal tax-free. That sounds like a pretty good deal.
So one really important thing to remember is that if you've had a capital gains event, you have 180 days from that event to invest into a qualified opportunity zone fund in order to receive those tax benefits.
So Eric, just to remind everybody, this is an IRS rule. This isn't specific to Urban Catalyst Fund, correct? And why do you think that the IRS made a deadline like this?
Well, the IRS really wants to promote social and economic benefit in opportunity zone areas. So they want to put people's money to work right away. And so they set this deadline as a reasonable amount of time for someone after they've had a capital gains event to consider investment into an opportunity zone fund, find an opportunity zone fund that they want to invest in, and then pull the trigger and make that investment.
Perfect. So now our investors know, or people watching the video know, what the tax situation is for their gain. They know what the benefits of opportunity zone investments are, and they know that they have only 180 days to make a decision. So next, why don't we talk a little bit about Urban Catalyst and what makes us unique?
So here at Urban Catalyst, we started fundraising for our second fund in January of 2021. And over the last couple of years, we've been featured pretty prominently in the news. We've had over 175 news articles written about us.
Yeah, and I mean, it's interesting because the founders, Eric, Josh, Paul, the development team, they have been well known here in Silicon Valley as ground up developers for their entire careers. But I'll tell you one particular piece of media that I was very proud of coming from the tech industry is that we actually won the Forbes Top 20. Urban Catalyst was chosen as one of the 20 best opportunity zone funds in the whole country by Forbes magazine.
And that's just national validation from Forbes that we're doing things the right way. What makes Urban Catalyst different than other opportunity zone funds is that we're not just fund managers, but we're also developers of all of our projects. And most other opportunity zone funds, that's what they are. They're funds. Their plan is to go out, raise a bunch of money and then scramble around the country looking for developers that have real estate projects located in opportunity zones, so that they can find partners. Here in Silicon Valley, obviously we look at Steve Jobs and Steve Wozniak and we say, did these guys go out, raise a bunch of money, and then hire someone to build them a computer? And the answer is, of course not. They built a computer and then they took it out to the market. And that's what we're doing here at Urban Catalyst in our second fund. We have 2 projects in this fund. We are the developers, and now we're taking these projects out to the market to finance them.
Here at Urban Catalyst, we believe in the entrepreneurial spirit. Eric, as president, started this company and founded it very much like a tech startup. So when we talk about Steve and Steve here, the analogy that we're drawing is that Eric's point of view was that he wanted to start a real estate equity fund in a different way. And what he did is he actually went and acquired great properties, and then we went out for investment. We look at Steve and Steve, and did Steve and Steve raise money first and then go out, hire employees, try and figure out how they were going to build a computer? And the answer is no. They sat in their garage, they started building the computer, took it to market, and that's when all the venture capital came to them. And that's really what Eric has built here at Urban Catalyst.
And just something to point out to anyone that is interested in investing into an opportunity zone fund, and that is the real estate is the most important thing about it. Obviously, if you're here, it's because you've heard about the tax benefits associated with the program. And don't get me wrong, we're big fans of the tax benefits here at Urban Catalyst. But what really matters is what is that underlying real estate, and who are the developers that are doing the development projects?
Yeah, and I can't emphasize this enough. If you come from the tech world, perhaps this might be a good analogy compared to the product, right? If you're at a tech company, no matter how good the rest of the organization is, if you do not have a good product, it's all irrelevant. It's not going to fix the problem. So that's why real estate is the most important part of our Opportunity Zone fund, and we feel it should be for every fund.
I mean, if you think about it, if the biggest benefit is you get tax-free profits after 10 years, there better be profits after 10 years, or really what's the point of the entire program? So to talk about us as developers, I started Urban Catalyst in 2018, and my plan was to really build an all-star team of downtown San Jose developers. I did just that by bringing on Josh and Paul. I've known both Josh and Paul for over a decade. Josh is our chief operating officer. Prior to Urban Catalyst, he was the lead developer for Barry Swenson Builder, managing their entire and quite extensive downtown San Jose portfolio and getting experience building a variety of different types of projects. Paul Ring, he was the lead developer for 15 years at a place called the Core Companies. He specialized in multifamily and below market rate housing here in downtown San Jose. So quite a bit of development experience, especially here in downtown San Jose. We're not just developers, we're also fund managers. We brought on Morgan Mackles and Sean Raft to round out our program. Morgan, obviously, who's sitting next to me, I've known Morgan for over 25 years, and he's the primary reason why we were so successful in raising over $131 million in our first fund. In general, Morgan has worked for big and small companies, and he specializes in building scalable and repeatable processes. Sean Raft, Sean is our chief administrative officer. He's an attorney, and what he does here at Urban Catalyst is he manages our legal teams, our finance, our accountants, and our fund administrators. He's also responsible for all of our compliance with the SEC, as well as the Opportunity Zone rules and guidelines. A really easy way to say it is Sean really dots the I's and crosses the T's here at Urban Catalyst.
So Eric, I know that you often talk about bringing together an all-star team. So let's look at exactly how much experience everybody has when you combine everyone.
So combined as developers, we've done over $5 billion worth of real estate development projects in Silicon Valley. And Morgan, you can see that heavy concentration in downtown San Jose. And to show you the location of the Opportunity Zone funds here in Silicon Valley, and specifically here in San Jose, we want to show you this slide. You can see that there are 4 opportunity zones that cover most of downtown San Jose.
Yeah, so I know that one of the areas that Eric, you really like to focus on is how exactly it is that you and Josh originally decided on the San Jose specific opportunity zones as opposed to opportunity zones in other spots.
It's an interesting story. Josh and I, when we were talking about forming a fund, we wanted to focus on doing a fund here in downtown San Jose. We wanted it to be a ground up development fund. And that was because of the overall macroeconomic trends throughout Silicon Valley, all pointing towards downtown San Jose as the next place to do development on a large scale. And it was only after we started forming Urban Catalyst that we learned about the Opportunity Zone program, and that everywhere that we were planning on building projects was already located in the zone. And because we've been developers all over the Bay Area, there are really 3 primary things that we look for when we do development anywhere. And let me go through those with you really quick. The first is we want to make sure that there is demand for all of the different types of projects that we're building. Obviously, that demand here is driven by the Silicon Valley job engine. We want to make sure that transit and physical infrastructure is already in place. Here in downtown San Jose, it's really the only true urban environment in Silicon Valley. The Diridon train station is one of the largest train stations on the West Coast. There's a variety of mass transit options that connect to it already. And now BART is funded to come through downtown San Jose, connecting into Diridon Station. And then you really can't talk about downtown without talking about San Jose State University. With over 35,000 students, it's the second largest university in the Bay Area behind Cal Berkeley. Last but not least, we want to do business in a place where the local government wants to see development happen. And by the way, that is not the case in most California cities, but it's absolutely the case here in downtown San Jose. This is a picture of Josh and I with Sam Liccardo, the mayor of San Jose. Sam's been the mayor for 7 years. And before that, he was the council member representing downtown for 8 years. It's really the policies that he's put into place that have streamlined the pre-construction process and just made it so much more attractive for developers like Urban Catalyst to do business here in downtown San Jose.
So Eric, for me, when I joined Urban Catalyst, I actually came from the tech world, and I didn't understand how difficult it was to actually work with a city to get things built. Do you want to maybe tell everybody a little bit about some of your other experiences and kind of how it compares to San Jose?
Sure. So, I mean, everybody has read in the paper and heard the horror stories of getting projects all the way to building permit, and you know they're quite extensive. It can take years in some cases. I did a project in Oakland. From the day it was acquired to the day the first unit was delivered, it was 20 years. Now, that's a kind of an extreme example. But I would say on average, 2 to 3 years could be expected before you could break ground. But here in downtown San Jose, they've streamlined that process. What we're experiencing with our Fund 1 projects is that it's about 18 months from when we start the project to when we break ground.
So right now, for our Fund 1 projects that are already in flight, we're seeing that we're right on time and on schedule at about 18 months estimated. Is that correct?
That's correct. To talk more about what's happening here in downtown San Jose, this is a map of downtown. This black line represents the opportunity zone. Here's our headquarters. We're right here in the zone. We're right next to Adobe's world headquarters and Zoom's world headquarters. I mentioned San Jose State University, and then this red dash line, that represents the BART line that's going to be going in underneath Santa Clara Street, a couple stops downtown, and then connecting here into Diridon Station. But Morgan, of course, the big news over the last couple of years.
The big news has been Google. Obviously here, Eric, you can see that we have Google in that green color here, and it really is breathtaking to see visually just how large that project is going to be. Tell us a little bit about what Google has already purchased and what their plans are here.
Sure.
Downtown San Jose.
So Google in the last 2 years has purchased over $450 million worth of property, and that's over 80 acres. The plans that they've submitted to the city show them building around 7 million square feet of office and 6,000 residential units. At build out, this will be Google's largest campus on earth. And Morgan, the real reason why they're here is they wanted a place where it was closer to where their employees lived, and it was next to mass transit, and there was enough available land to do this giant mega campus. And here they are. I guess the really good news for downtown San Jose is that throughout the pandemic, Google has continued to acquire property and really press the city to approve their plans. Their plans are expected to be approved here in the next couple of months.
Yeah, so Eric, obviously with the pandemic, I know that there's been a lot of concern that Google might be slowing down, but really that's not the case at all, correct? What is the latest news with Google?
So the latest news is it's really the city's process has been slowed. I mean, obviously this is a huge project, and the city had really wanted to get it done by December of 2020. Looks like it's going to slip by about 6 months and be approved in May or June of 2021. So we've also seen a tremendous amount of developers come into downtown San Jose in recent years. In purple, you can see J. Paul, and in green, you can see West Bank. In the last 2 years, J. Paul has purchased around $650 million worth of property in downtown San Jose. He's planning around 5 million square feet of development. West Bank, just in the last 6 months, has purchased $300 million worth of property. So here we have a bunch of large developers coming into downtown. We have big tech companies coming into downtown. And, you know, Morgan, this is one of the reasons why I decided to start Urban Catalyst.
Yeah, I think that one of the most important things about this slide is pointing out that giant developers like J. Paul and West Bank are actually coming into downtown San Jose. And frankly, they did so after you got started on executing this plan for your first opportunity zone fund, correct?
Yeah, we saw this wave of development coming, and really our plan was to get in on the ground floor, acquire property before these other developers and big tech companies drove up the price of land. And that's exactly what we did with the acquisition of our Fund 1 and Fund 2 projects. Here in blue, you can see our Fund 1 projects. We plan on starting construction on all of these projects within the next 12 months. We have a variety of different asset classes in Fund 1. These are the 6 projects that we have in Fund 1. A couple of office projects. We have multifamily. We have an extended stay business hotel. We have a senior living facility, and we have a student housing high rise. But now we're on to Fund 2, Morgan.
Yep.
Fund 2, really excited about. It's this orange property right here next to the future BART station. Location, 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 as they say. Great location for this property. It's right across the street from City Hall. It's on the main drag, right in the central business district, and right next to a future BART station. So you really can't have a better definition of transit-oriented development.
And one of the things that I think it's very easy to see here that really sticks out is you're looking at almost an entire block, right? A nice contiguous square there. What does that actually represent, and why is that important for our investors?
So we have almost 2 acres of property. It's almost half of an entire downtown San Jose city block, and those types of developments, those types of parcels, very few and far between. What it allows us to do is really build a constructible, functional project. And for our investors, what that means, it means our buildings will be less expensive to build, which makes them more profitable, so we give those profits to our investors.
Perfect. Let's take a look.
This is our Icon Echo project. These are the 2 projects for Fund 2. So this is that whole 2-acre block. In the foreground here, we're building a 300-unit multifamily apartment building. And then in the background, we're building a 420,000 square foot office building. Let's talk about Echo first, Morgan. Echo is a multifamily project. And really what you want to know is, what is the demand for this type of project in the Silicon Valley market? And I can tell you, here in Silicon Valley, we've created 5 jobs for every housing unit that we've built for over 30 years straight. And that has caused what some people call a housing crisis. It's why we have some of the most expensive housing, both for sale and for rent, in the entire world. So when it comes to demand for multifamily, we literally can't build it fast enough to meet that demand.
Yeah, so Eric, I'm a huge fan of multifamily. I've lived in a bunch of these buildings before in my life in New York and San Francisco. Can you tell us a little bit about what's going to make Echo special?
Sure. So when we build multifamily projects, I've built thousands of multifamily units here in Silicon Valley. What we're really looking to do is build great functional floor plans for our future residents, but also build cool amenities into this space. As you can see from this angle, the Echo project, we have a pool deck. Along the pool deck, we're going to have 2-story amenity space facing the pool deck so that you can have these big roll-up doors, and you can have a bar kitchen area that goes straight out onto the pool. We're also going to have a large movie room that goes out of the pool, a dining room that goes out to the pool. We're planning on putting in, and Morgan, I think this is probably my favorite part, we're putting in a speakeasy with a hidden door. And we're going to have local breweries every Friday come and pour free beer for all of our residents. We also have this amazing rooftop deck. Inside here will be another 2-story amenity space. And that is going to have an area for, a place where you can go and work. You don't want to work in your apartment unit. You can go up to this area. It'll have desk area, great Wi-Fi, has little phone booth rooms. There are a couple of breakout offices, a conference room that at night can double as the dining room. And then if you're on the phone and you want to walk around outside, go ahead and walk out onto that rooftop deck. Talk on the phone, do your thing, or just catch a view of the city, watch a view of the sunset. So amazing amenities is what really makes an apartment building attractive to tenants here in the Valley. Our other project, as we've seen, is the Icon project, and this is our office. So 420,000 square feet of office, and kind of what makes office a little bit different than residential from a demand perspective is that while we literally can't build the multifamily fast enough, we can build office fast enough to meet the demand. So when we build office, it has to have certain criteria so that when we compete with other new office, we're going to get that tenant. What we are able to do here is we have all three of the major points that we want to see. The first is location. You know, we talked a little bit about the location, but being next to transit right on the main drag is important. The second is functionality. Functionality, when it comes to the design of an office building, you have to think we're delivering a cold shell to our future tenants. So everything has to be perfect. And by perfect, I mean the perfect parking ratio of 3 spaces per 1,000 square feet of office. The perfect floor to floor height of 15 feet so that we can have those elevated ceilings that everybody wants to work in. And 40,000 square foot floor plates. And I can't emphasize that one enough, Morgan. Tech tenants that look to locate their offices, they want to see these big fat floor plates of 40,000 plus square feet. And we're able to do that here at Icon. The last thing that we want to see is we want a beautiful building. We want a building that is aesthetically pleasing so that when someone sees it for the first time, they can think that is a place that I want to relocate my business. That building represents how amazing my company is. We've hired a world-class architect here in the Valley, WR&S, to design this building so that we can really have that amazing aesthetic quality.
That's great. And Eric, I think now that we understand what the projects are going to look and feel like, I think the next important question is, what's the timeline? When are they going to get built?
So in our first fund, we had a 12-year timeline. We raised money for 2 years before we started that 10-year hold. Here in Fund 2, we have a 3-year fundraise followed by a 10-year hold. So we're raising money starting in 2021. It's a $200 million fund. Our minimum investment size is $250,000. That was the same in Fund 1, Morgan, but wasn't our average investor size slightly larger?
Yeah, our average investment size in Fund 1 was a little bit under $400,000, which means that our average individual investor invested nearly $400,000 in total.
Yeah, and our largest investors in Fund 1 were closer to that $5 million range. So we definitely had a good range of investors. Here's where you pay your taxes in 2027. And then after that 10-year hold, sometimes we call it 10 years in one day, we plan on selling all of our properties, and that's when we return the majority of the profits to our investors.
Right, and Eric, when you say pay taxes, I just want to be clear, which taxes am I paying there in 2027?
You're paying the taxes on your initial capital gains event. And I'll tell you, Morgan, we get questions a lot from our investors or potential investors. The first question is, okay, so it's this 10-year hold. Are you planning on making distributions prior to the end of 10 years? And if so, are you going to make distributions in large enough amounts for me to pay my taxes in 2027?
Right.
And the good news is the answer to both those, the short answer is yes, we are making distributions. And yes, it should be in a sufficient amount to pay your taxes in 2027. Now, one caveat that I always need to say is, of course, nothing is guaranteed with the investment into any fund like ours. My attorneys always want me to mention there is significant risk associated with investment into real estate or any other types of funds that you may invest in. Now, that being said, I can tell you what our plan is. Our plan is to start distributions in 2026. And let me walk you through sort of how this works. It's called our refinance and distribution program. Sometimes I call it Developer 101 because it's something that we do quite often. We're planning on starting construction of our buildings here in 2022. By 2025, they'll be completed and we'll start leasing them. By 2026, they'll be completely leased and stabilized. And what we do at that time is we go out and we get permanent financing. We take that permanent financing and we use it to pay off the construction loan that we had to build the buildings. And then any excess refinance proceeds, we plan on passing those through to our investors tax-free.
So Eric, let me jump in here and speak kind of for the investors that we had in Fund 1. Because such a high percentage of our investors don't have prior expertise in commercial real estate, I got a lot of questions about how exactly this works, right? And I want to be sure to clarify, this is actually an aspect of regular ground-up development, not something special and unique to the Opportunity Zone program, correct?
Yeah, no, this is why you do regular ground-up development, is because you're building this building for significantly below the value, which is why you build it. So by the time that you get a tenant, you have a building that is worth quite a bit more. So when you go out and you get that permanent financing, it's more than the construction loan, even though it's the same percentage of loan to value.
And at that point, we're actually able, instead of keeping that extra money, what we're actually able to do in this case is we're going to be distributing that back to investors, correct?
Yeah, that's right. It's a tax-free distribution. In 2026, it'll be the first distributions that we make to investors, and it should be of significant size for our investors to be able to pay their taxes in 2027. After that, we're more like a core fund. As we wait to get to those tax-free profits, we'll have these stabilized assets. And just like real estate in general, they'll be cash flowing. The nice part about our fund structure, we are an LLC, or the fund is an LLC, and that allows us to pass through not only the cash flow, but also passive losses. And let me tell you why this is important, and it's something that is sometimes overlooked when you think about investing into an opportunity zone fund, is we have passive losses. We're able to pass those passive losses through to our investors. Just like any real estate owner, we'll be taking depreciation on those real estate assets. That's something you can write off on your taxes every year. The difference is because we can provide passive losses, we're able to take that depreciation as a passive loss and pass that through to our investors. Our cost segregation analysis that we did in Fund 1 showed that we passed through significantly more passive loss over this 10-year hold than cash flow. In essence, making that cash flow tax-free.
Right. So I want to be sure that that we are clear on this point, because I definitely get a lot of questions from investors. That cash flow from 2026 forward, that cash flow is real cash that is targeted to be distributed to our investors. And what you're saying is that in actuality, when investors receive their K1, this is not going to be taxable to the investor?
That's right. In fact, they're going to have significantly excess passive losses. The good thing about passive losses is that they carry forward forever and can offset other types of passive income. But one of the benefits of the Opportunity Zone program that is only for Opportunity Zone funds is that when we sell our properties at the end of 10 years, you don't have to pay back that depreciation or all of that passive loss that you've received. Typically, if you own real estate, you have to pay it back. But for Opportunity Zone funds, there is no depreciation recapture. In fact, what happens, Morgan, is all of that built up passive loss that our investors have accumulated over the 10-year hold, that changes from passive loss to active loss. And active loss can offset things like ordinary income, which is really a nice extra little benefit of the Opportunity Zone program. Obviously, ordinary income is in general a higher tax rate than capital gains, passive loss. So a nice little cherry on top.
Yeah, and I'll tell you, Eric, even though these are very complex tax details, I'll tell you that the one group that just absolutely loves the Opportunity Zone program are accountants and CPAs. We've gotten a ton of referrals from individual investors, their CPA or their tax advisor, telling them to check out all of these benefits that are inherent in a pass-through Opportunity Zone program because of these great tax benefits. So Eric, we talked a little bit about capital gains, specifically from the sale of stock. We talked about what kinds of taxes taxpayers are likely to owe. We talked about the Opportunity Zone benefits and how they can help defer and reduce that tax obligation. Then we talked about why investors should invest in Urban Catalyst, and we talked about the projects that are going to be in Fund 2.
My favorite part, Morgan, is always the San Jose story and the amazing projects that we have put together for Fund 2 and our Fund 2 investors.
That's great. And Eric, if people have questions, how can they get a hold of us?
Please visit us at urbancatalyst.com.
So Eric, now what we're going to do is we're going to take some of the most frequently asked questions that we hear from investors. And since we have you captive, we're going to go ahead and ask our president all of the different questions that are most common.
Fantastic, Morgan. Can't wait.
Okay. So first common question is this investment a blind pool?
And the answer to that, Morgan, is no. And for those of you that are unaware of what a blind pool is, a blind pool fund is a fund in which they ask you to invest, but they don't have any projects. So we have 2 projects in Fund 2, which makes us not a blind pool fund. Those are the only 2 projects that we're planning on having for this fund.
Yeah, and I'll jump in and say that is an incredible advantage and selling point for our fund, in that you as the investor already know exactly which projects you're going to be investing in. And that's not always the case.
That's right, Morgan. And it's a lot easier for investors to understand their projects and really wrap their minds around what they're investing in, instead of just saying, give me your money and trust me, we're going to have great projects. Here are the projects that we have, and you can judge for yourself.
Right. Okay. Next question. The next question is, how about us? Are we first-time fund managers?
And the answer is no, we're not first-time fund managers. We recently completed our fundraise of our first Opportunity Zone Fund. It was a $130 million fundraise. We were oversubscribed, 350 plus investors. And that was also an Opportunity Zone Fund focused on downtown San Jose.
Perfect. So how many funds does Urban Catalyst have in total?
So right now we have 2 funds in total. In the future, we may have other funds, but right now we only have 2.
Great. So, Eric, we get a lot of questions about the background of especially the development team, which is really important. So have you as the development team done projects here in the San Jose area?
Absolutely. We have extensive experience doing ground up real estate development projects in Silicon Valley and especially here in downtown San Jose. We really are built to be downtown San Jose developers.
Okay, so here's a common question that we get, Eric. Is Urban Catalyst actually the fund manager, or is Urban Catalyst the development company building the projects?
So for us, we're both. We're not just the fund manager, but we're also the developer. And that really gives us an advantage to other Opportunity Zone funds. And the reason being is we get to control our own destiny. We're not out there looking for projects, trusting the developers as to what they say will be their project schedule, what they say will be their project returns. We know what the schedule is. We know what the returns are going to be. We have this, background and experience building these projects. It also, from a fee perspective, gives our investors comfort because they're able to see, with transparency, what are our fund fees and what are our developer fees. When you partner with an Opportunity Zone fund, they're not the developers. You get to see what the fund fees are, but those developer fees remain hidden from you.
Yeah, so having that local experience and expertise building here in Silicon Valley, Eric, how does that actually benefit our investors?
Well, development is a very local business, and understanding the city, understanding the markets, what asset classes work and where, how to process your projects, how to pick the right contractors to build your projects, all of those things come down to, are you a local developer and do you have experience building in the local area, which we have extensive experience.
So it sounds like it's extremely important to understand what you're buying the projects for, how you're going to save money on building them up, how you can sell them for the most amount of money, and that's going to be beneficial for our investors.
Absolutely, especially when it comes to acquiring the land initially. One of our greatest strategic advantages here in downtown San Jose is we've been doing business here for so long. We know all of the downtown San Jose property owners, and that's how we've acquired properties at that below market price that allows us to really create great returns for our developers, or for our investors.
So does Urban Catalyst Fund 2 anticipate giving distributions back to investors before they have to pay their taxes for the tax year 2026?
Yes, Morgan, we do plan on making distributions in 2026. They should be in sufficient amounts for our investors to pay their taxes in 2027. And we plan on doing that through our refinance and distribute program.
Great. So once the investments are made, will our investors be receiving a K-1 or a 1099 as their tax document?
Investors will be receiving a K-1. And one of the really nice things about Urban Catalyst is because our projects are located here in California and only in California, it's just one K-1. A lot of other funds out there, they have projects all over the country, and kind of comes as a little bit of a sticker shock when your accountant gets 10 K-1s they have to deal with. Anyway, our investors do prefer one K-1.
Yeah, and so I know that Urban Catalyst is structured as a partnership. What are some of the advantages for our investors of the partnership structure?
Well, the first major advantage is that we're able to pass through tax-free distributions through our refinance and distribute program prior to 2027. That's number one. Number two is we're able to pass through losses to our investors, and that is a quite significant advantage because that allows us to pass through the depreciation, which we talked about, and that depreciation we plan on having in excess of the cash flow that we're distributing, making all of that cash flow tax-free. And at the end of the 10-year program, because we're an Opportunity Zone fund, there is no depreciation recapture, so all of those passive losses we pass through, our investors get to keep.
Great. So Eric, We mentioned at the beginning of the program that this fund is a $200 million fundraise. So when is the fund going to stop fundraising?
So we're planning a 3-year fundraise. That's 2021, 22, and 23. And this is based upon the velocity in which we raised our first fund, which we averaged around 65 million a year. However, our fundraising velocity has accelerated. In our first year, we did around 50 million, and that was 2019. In 2020, we raised 80 million. We're going to raise money until we hit that $200 million mark, and then we're going to close the fund. We wanted to give ourselves enough time to do that, so we are showing a 3-year fundraise. However, more than likely, the fundraise will end before the end of 2023 because we will have hit that $200 million mark.
All right, let's talk about, okay, so Eric, the big win in the Urban Catalyst Fund is when 10 years arrives and you get to sell the projects, right?
That is the big win for our investors. Right?
Okay, so tell our investors, we get questions all the time. How are you going to sell the properties? What's the plan? When is it going to happen? And who is going to be buying these properties?
So, when I talked about my background of building institutional and quality scale projects, what that really means is after my projects are built, my exit strategy is to sell to a large institutional real estate group. Historically that's been REITs or huge real estate equity funds. So you want to build the projects that it is unit size, square footage size, monetary size that those groups are going to be interested. Our plan after 10 years, it's really going to start in the 9th year. We're going to start marketing those properties for sale. And then we're going to find that buyer. We're going to set everything up. And we're going to close escrow on those properties with that buyer as soon as we can after we hit that 10-year mark. Because overall, our goals here for Fund 2 is really threefold, Morgan. We want to maximize our investor returns. We want to get them their money back as soon as possible. And we want to do it in a tax-advantaged way.
Eric, I've heard you talk to our investors and mention what you see as the 3 main goals for how we're delivering to our investors. You want to walk through those?
Sure. Our plan here at Urban Catalyst in our second fund, it's really, as you said, it's threefold. We want to maximize our investors' returns. We want to get them their money back as soon as possible, and we want to do it in a tax-advantaged way.
So Eric, throughout your career, you have built buildings and you've actually sold them to large institutions that purchase real estate. Can you give us some examples? Like, who are these types of companies that will buy projects at this scale?
Sure. In general, these projects are institutional quality and scale, which I have a lot of experience building throughout my career. And the exit strategy is always to sell to one of these large groups. Traditionally, it's REITs, publicly traded REITs, or large institutional investor equity groups that are looking to buy at this scale. And so we intentionally set up our projects so that they are larger, so that this can be our exit strategy.
So Eric, what would you say to investors that are concerned about the current market and the effects that COVID might be having on the California market or the Silicon Valley market?
Sure. So Morgan, when we talk to investors, this is a really common question. You have COVID, people are working from home. What will be the demand for office coming out of COVID? Or on the flip side, a lot of articles in the newspaper about people leaving California and moving to other states. When we look at investment into this fund, obviously this is a long-term investment. We're talking about a sale in 2034. And the real question is Silicon Valley going to be Silicon Valley over a decade period? And the answer is yes. We still have, really the 3 things that make Silicon Valley, and that is high concentration of technology workers. We have more venture capital funding than any other place in the world. And we have 5 of the 7 largest companies in the United States headquartered here in Silicon Valley. And that's not going to change because of COVID for a year or 2. Over the long term, Silicon Valley has shown it's typically the last place to go into a recession and the first to come out. The Silicon Valley companies here, even during the pandemic, have all been experiencing significant gains, really driving the stock market. So from a market risk perspective, Silicon Valley is the place to be. And as we were talking about, one of the reasons why we've seen so many sales of existing office product recently.
One of the questions that a lot of investors have is about their risk and downside scenarios. So in real estate, risk is a little bit different than in my own background in tech startups, but what do you see as the downside risk for our investors? What are the worst things that can happen?
So my attorneys would tell me to say the worst thing that can happen is you're going to lose all of your money. Nice thing about this fund is there's no additional liability. That's the worst thing that can happen is you lose all of your money. But the difference between, say, being an angel investor in a startup and investing into real estate is that real estate, we have tangible assets. And it's really hard for the value of those assets to go to zero, especially if we're not utilizing too much leverage. In Fund 2, we plan on using 65% leverage, which is not a huge number, which should make investors feel a lot more comfortable about their investment, because in a worst case scenario, there'll still be 2 high-rise buildings with tenants, and the loan amount is only going to be 65% of that value, which is significantly lower than traditional, where most folks are used to buying their single-family homes and using 80% leverage, right?
Yeah. So in other words, I think what it is that you're saying is that even if something goes really wrong with the management entity or the management group, there's actually still hard assets, tangible assets that the investors will be a part of.
That's correct, and there should be significant equity built into those tangible assets.
Eric, you mentioned earlier in the fund a minimum investment amount. Can you restate that?
Sure. Our minimum investment amount into Fund 2 is $250,000. In Fund 1, our average investment size was just under $400,000, and our largest investors were in around $5 million.
So Eric, we get a lot of questions about that 180-day deadline. So how exactly does that work? When do you start counting?
Sure. So the 180-day deadline, you start counting on the date that your capital gains event occurs. So the date you sold your stock, the date you sold your property, the date you sold your business. That starts the 180 days. The 180 days ends either after 180 days or the date that a qualified opportunity zone fund receives the money in its bank account. That's the end. We send a receipt to our investors. It says, here's the name of the fund, here is the amount in which you invested, and everything that they're going to need to give to their tax professionals so they can fill out their tax returns appropriately the next year and receive those tax benefits.
So Eric, we're getting an increasing amount of investors that invested in Bitcoin. If they made a bunch of money in Bitcoin and they have a big tax bill, does that work for opportunity zone investment?
It absolutely does. Bitcoin, the sale of Bitcoin is a capital gains event. And so it definitely works with the Opportunity Zone program. Opportunity Zone program will help them shelter their tax burdens.
Eric, when you read the fine print, there's mention of bonus shares, and that sounds exciting. What are the bonus shares?
Sure. So really a popular program in our first fund, which we've carried over into our second fund, is our bonus units program. We have 3 types of bonus units. The first is called our time incentive credit. That rewards investors for earlier investment into the fund. So if you invest, say, in the month of March, you get 8.25% bonus units. That decreases every month. And what that means is, say, if you bought $100 worth of our units and it was in the month of March, you would receive $108.25 worth of our units. Our second program is called our volume incentive program. And that is based upon the amount of money in which you invest, you get additional bonus shares. And what's really nice, Morgan, is those bonus shares add together. So you can get your time incentive credit and your volume incentive credit. The last one is called our multiple ventures program. Sometimes we call that our MVP program. And that is for our investors in Fund 1. If you invested in our first fund, we give you additional bonus units for investing into our second fund.
And so am I correct that all of those different types of bonuses are cumulative for the investor?
That's right. They all add together.
That's great. So once I make my investment into Urban Catalyst, how long does the investment need to stay there?
So when you invest into Urban Catalyst, we have the minimum 10-year hold after we finish fundraising. And that is in order to get those tax-free profits. So we don't plan on selling any of our properties or returning the majority of the profits until after that 10-year period.
To be clear, the hold period is at least 10 years. And the reason it's 10 years is because we want our investments to adhere to the IRS OZ rules. Is that correct?
That is correct, Mark.
So Eric, I actually talked to a lot of investors who want to know why you started this company in the first place. Kind of what's your origin story?
Well, I've been a developer throughout my entire career, And I've always had a passion for revitalizing downtown San Jose. And when I had the opportunity, I saw the market forces at work, showing that downtown was really going to explode. I wanted to be a part of it. So I formed Urban Catalyst, got in on the ground floor, acquired properties, started our first fund and our second fund. We've been very successful in our fundraising. We plan on breaking ground on 6 projects just this year, 1 project next year and 1 project the year after. But overall, this creation of a cumulative effect in downtown over the next 10 years is just going to be amazing. You're going to see tremendous development. The town is going to be a giant city. It's going to be something that we've seen throughout the country in places like Denver and Austin, where the town just completely changes and you go, man, have you been there lately? It is an amazing place now. We've already seen that start, and we're just helping to continue the ball rolling.
Everybody, thanks for attending the How to Shelter Your Gains tax webinar. If you would like to get a hold of us at Urban Catalyst, please visit our website, www.urbancatalyst.com.